Once again, my name is Bob Hahn. I'm with Hahn Houle Chartered Accountants. I do have to tell you that putting together this presentation was a lot of fun. My goal for the next 25 minutes, 30 minutes is to convince you that accounting can be fun. So we're going to poke holes at accountants and the traditional accounting model. So we're going to if you think of the mothership, this is the traditional accounting model. And we're going to see whether this ship really should be floating even at that level. We're not going to sink the ship, but we're going to take some shots at this ship to see whether there's something that we can do differently in the accounting model. I do want to also reiterate, when we're talking about process improvement, this applies to any business. I was out for dinner last night. Jane was challenging me about she's going to a board meeting, and the board meeting is going to be a full day long. So she said, would lean apply to a board meeting? And we started talking about that a bit. And just think of any process, anything that you do, could you take the waste out of any process? One of the books I've been listening to refers to just worrying about your own waste. You have a mountain of waste, you have a lifetime of waste to deal with in your personal life and in your own business or your own four walls of your office. Just worry about your own waste, if you like, and eliminate that waste. So this applies to any business. That's really where I'm going with this. You do not have to be Finning. You do not have to be Toyota. You can be an accounting office and eliminate waste in the accounting office. Okay, so this applies to all of us. It can apply to your home, it can apply to your bathroom. Anything. Okay, so we're going to take a shot at accounting, and I love this because I'm poking fun of myself. I've been an accountant for many, many years, and really I think what we've been measuring, my premise here is that I'm not sure we're measuring the right things. So let's have a look at some of this stuff. What's wrong with traditional accounting? We go to school, we go to university, then we get our CPAs, I guess now that's the designation, I got my CA. We study all of these kinds of concepts about how do we value assets. And some of these concepts actually point our managers in making wrong decisions. There's things that we call these things like absorption accounting, and we do all these calculations of all of these fixed costs. We want to add all of this notional value to inventory. And so the higher the inventory, common rule, higher the inventory, higher the profit number, which is exactly the wrong decision in lean thinking and process improvement thinking. We don't want inventory. Why create inventory unless it's unless we're selling it? If it's sold, it's not inventory, it's gone. So a lot of these things that we do in accounting and all of these absorption, cost accounting stuff, whatever, if we talk about extreme lean, we just cannot. We just wouldn't do any of those things. But we're not going to go extreme today. We're just going to say what's wrong with our existing accounting systems and how do we make things different. So that's the first bullet there. Some of our systems are very complex. I'm not sure we need to be that complex. I think in terms of accounting, your accounting departments, typically they probably measure things that maybe don't need to be measured. Maybe we need to think again about forcing your accounting side to why don't you measure things, why don't we measure waste? Why don't we measure, see if we're doing better at our processes? And traditionally, our traditional accounting model, I believe, forces our decisions to make decisions that are wrong and based on historical information. If indeed more inventory equals more profit, our managers are going to go out there and create more inventory, and we can't even sell that crap. Like, why are we making that decision? So let's challenge that thought. So lean companies, process improvement companies seek to understand costs associated with processes and value streams. So Mark already has demonstrated or talked a little bit about what value streams are and what processes are. So we want to challenge ourselves. So let's take torpedo number one, and we're going to fire this sucker at this big ship and say to ourselves, what are customers willing to pay for? What you see here is your traditional income statement. So you're going to see this at the end of the year, at the end of every month. regular sales, cost of sales, gross margin, nothing wrong with this. And we then go on to have our general and admin expenses, and we come down to a profit number. So that's traditional accounting model. Let me say that any of the ideas that I'm coming up with here will not challenge generally accepted accounting principles. We do need to report under the handbook, and so anything that I'm going to be suggesting is not deviating from that. This is still generally accepted accounting. I'm just suggesting we're to think of things slightly different. Under a lean or process improvement accounting statement, let's think of things slightly differently. If we broke our income statement into two value streams that we had in our business and identified, just like we did before, there's no difference here. Our gross margin is still the same. We've just broken it down into two different value streams. And maybe I'll just use an example here. If you were in the trailer manufacturing business, you may be manufacturing trailers, like the 16-foot trailer, the standard trailer, it's aluminum, whatever it is. That standard trailer might be one value stream. A second value stream might be the specialized trailer. You take that base chassis and you say anybody that wants it engineered so that it has air conditioning, that it has satellite control, all this kinds of stuff, that might be value stream number two. So let's use that as our example here. Maybe I should probably reverse that. The specialized trailers probably have a better margin. So the specialized trailers might be this one and the standard trailers might be here. So that's pretty standard. You might say, well, I already do that. That's divisional accounting. That's no difference. So Bob, you know, that really isn't the big bullet at the ship yet. I think what I'm challenging you to think about is to break down these other expenses here in terms of value-added expenses versus non-value-added expenses. So how do we define what value-added expenses are? And that is, if we ask ourselves, which are the expenses that our customers are willing to pay for? So that's the key. If our customer is willing to pay us for the rent on our manufacturing floor, then that's part of the value stream contribution margin. And you're going to see in a second why we're doing this split between the two. All of the amounts above this value stream contribution line, I'm suggesting that that's where all of your process improvement concepts, all the things that Mark is talking about on the shop floor, that's where that's going to be, you're going to affect all of those expenses up there. So that's process improvement, is all of those things above the value stream contribution. And that indeed would be what we show our value stream manager. He would get this number down to this point right here, because that's really what all the customers are willing to pay for. What are customers not willing to pay for? Customers are not willing to pay for discretionary travel. Me going for lunch yesterday with a friend of mine and I rated through my business. Yeah, customers are not willing to pay for that. Customers are willing to pay for the direct materials that go into the product, their direct labor, all of those kinds of things. So I'm suggesting that above the line here, those are items that customers are willing to pay for, and we apply all of our process improvement concepts. You heard about 5S, straightening up all of the items that Mark was talking about. Bullet number 2, torpedo number 2. Let's look at these other expenses, the ones that customers are not willing to pay for, and say, let's be brutal with these expenses. If customers are not willing to pay for these items down here, travel, maybe some staff functions, security system, parking, meals, entertainment, be brutal. You can cut those right out. Accounting, audit, not really. But as Mark had mentioned earlier, you can't just eliminate all of these. But truly, if the customers are not willing to pay for these, be brutal with these, but be careful, and you can't cut them out completely. The immediate effect on the bottom line, obviously, is straight profitability. So if whatever we can save here, the bottom line goes up. So So we can see an immediate improvement here. This is where we want to cut our costs in the non-value-added items. Typically on the value-added items, the items above, you wouldn't want to buy inferior metal to go into the trailer manufacturing if you're going to have an inferior product at the end. Don't save costs there, save them down here, and worry about process improvement on the upper side. Number 3, let's stay as close to the hazards as possible. So if you look at our high water mark, there are some hazards that we want to reduce our costs, and we want to make sure that we're floating our ship as close to these hazards as possible. We need to make sure that our staffing levels are at the appropriate levels. Inventories are at the lowest possible. Some other employee idle time, inefficient processes, we want to eliminate or stay close to the minimize rework, etc. So that would be our third bullet, is to stay as close to the hazards as possible. Number 4, and I think this is where I think the accounting departments need to be challenged a lot. Let's measure what matters. So this is our 4th torpedo today. If we think of our current organizations, this is our cost element within our organization. We have our profit element, and we have a certain portion of waste within our organizations. Could we concentrate on the waste element within our companies? And let's talk about what we measure. And I'm suggesting that in our traditional accounting models, we don't necessarily measure the wastes. Mark mentioned the 8 wastes. Just as a refresher, overproduction. Can we measure overproduction within the organization? Absolutely we can. Is there excess inventory that we're taking off the line and putting into the warehouse? It sits there. Just walk through your warehouse and see how many items have dust on them. Overproduction. Can we measure that? Yes. Transportation. We're overproducing. We need to transport that into the warehouse, back to the shipping department. All of those things are these transportation items that could be considered waste. Can we measure that? Yes. Excess inventory. So inventory turning over. Why indeed are we creating inventory? Are we creating inventory only to keep our people busy? One of the greatest wastes that we have. And that's really what process improvement is all about, putting through the system only what you're selling at the far end. Traditional accounting does not measure these things. And I'm suggesting that we need to start measuring these things to monitor the improvement of your organization. How many defects do we have? How many of those items go back into the process and need to be reworked? Number 5, overprocessing. Because of the defects, do we now overprocess? An example there might be that now you had a defect, you put it back into the line, they look at the defect, and they say to themselves, well, there's no way that quality control person is going to catch me again, so I'm going to check everything else. So now we rework the entire piece that we're working on. Total overprocessing. Definition of waste. Wasted motion. Once again, with defects, you're putting that piece of equipment right through the process again. To personalize this into the accounting office, how does this apply to us? Well, we start on a file. We have some errors in the file. It goes to our reviewer. We take it from the reviewer back to the prep person. We bounce it back and forth between the prep person and the reviewer. All waste. If we could eliminate that waste or reduce that waste, all of a sudden we would have a much greater experience, and we would also not have our customer waiting. Can we measure customer waiting? And customer waiting sometimes is referred to internal customers, that next person within the line. In my office, that next person, the reviewer looking at the file, or the admin person ready to print the file, or within the manufacturing, you could think of that. The external customer being your ultimate customer, if I could wow my customer by delivering financial statements in 1 week rather than 3 weeks, would they be happier? Of course they would be. Same thing with your customers. So can we measure that? I'm suggesting that we ought to. And number 8 is employee potential, one of the other ways. So rather than having that employee spending time working on defects, why not have that employee working on process improvement ideas and using their better potential? Can we measure all those things? I think Mark's description of what they do at OEM is pretty powerful. So traditional accounting measures, I'm suggesting that a lot of things we do encourage wrong behavior, and we could eliminate those things and just get rid of them. And by measuring, tracking, and reducing waste, we can maximize our profits. So that if you look at going forward, if we can eliminate waste or reduce the amount of waste, keeping the rest of the cost structure the same, that we ought to have more profit on our financial statements. And that's the benefit. So just to prove that, I want to just do a little crash course on business valuation. This is like the 2-minute course on business valuation. So if we took the premise that investors are willing to pay for your business based on cash flow, it's usually by way of a multiplier. In other words, as a multiplier is the investor's required rate of return. Investors are willing to pay so much if they're earning this much on the bottom line. So I'm going to give you an example here. So a multiplier is converted. If I'll pay you 5 times earnings if I want a 20% return on my money. It's arithmetic there. So if I were to want 20% of return on my money, I would earn, this business would be worth $1.1 million just based on cash flow on my income statement here. If it was 25%, I would be willing to pay you $880,000 for this business. So now we're through our process improvement piece, and we've increased our net income by $60,000. We went from $220 to $280. What's the benefit here? We have the same 20%, 25%. We now have increased our entity value from $1.1 million to $1.4 million. So there is a pop here. It's an exponential thing. It's a multiplier effect of saving $60,000, and all of a sudden our enterprise value has gone up $300,000. Pretty cool stuff. And your accountant's going to help you do this. So to summarize, what are the customers willing to pay for? So these are the torpedoes that are traditional ship. And let's think of value-added expenses, non-value-added expenses. Torpedo number 2, be brutal, but be careful with those non-value-added expenses. If you could, eliminate them, get rid of them, cut them down to a minimum. Number 3, stay as close to the hazards as possible. Measure those wastes, measure those possible things. And number 4 is measure what matters. The ship is not sunk, so thank you very much.
Hi, I'm Bob Hahn from Hahn & Gould Chartered Accountants. I hope you enjoyed the webinar. Remember, process improvement can be applied to anything, any process or any business. And when you apply this to your own business, remember to ask yourself, what is the customer willing to pay? Be brutal with non-value-added expenses and stay close to the hazards as possible. That means no excess inventory or staffing or labor. And lastly, but perhaps most importantly, measure what matters. And here's where we can really help you. If you'd like to learn more about how we can help your business or have any comments or suggestions in general, email us at info@honco.com or call us at 780-429-4403. Be sure to check out our website. There's a PDF with some interesting notes and concepts below. Website is www.honco.com for more resources on process improvement, lean accounting, and other seminars and workshops.